One of the unique things about having a niche like we do is that we can add value to properties that are 100% leased, 80% leased, completely vacant, everywhere in the middle. We want to be the number one strip center next to the most trafficked area. So next to that Walmart that is truly like where everybody's going. Today we have it down to a science, and it's a combination of a minimum amount of Walmart sales, a minimum amount of foot traffic that we now have like through sources like Placer and that sort of thing. And because of that, we know that the tenants that want to be next to Walmarts in small towns are going to want to go into our center.
So Walmart does the DD on the front end, and then you're looking at stuff like, perhaps whether it's a county seat or not, if it has some sort of large employer, a few other factors. But what exactly would you say are the most important factors you're looking at when you're just evaluating a market before you even look at a particular center?
Yeah, so today we have it down to a science, and it's a combination of a minimum amount of Walmart sales, a minimum amount of foot traffic that we now have like through sources like Placer and that sort of thing. Has Walmart rebranded or is it in the queue to be rebranded? And basically all the factors to make sure that Walmart has a big enough draw, they're doing well enough. We only go next to Walmarts that are owned by Walmart, so there's less risk of them ever moving or, just another party in the way that may add another level of risk. But at the end of the day, it's if Walmart's doing well, we know there's enough people going there to, provide that sort of success for that store. And because of that, we know that the tenants that want to be next to Walmarts in small towns are going to want to go into our center. And, for anybody that is familiar with, the more traditional way of like demographic research, it was always impossible to do it in rural towns, small towns, because you couldn't do the radius, the rings. So you couldn't do a 10-mile ring and say, all right, well, this is the population, and so it doesn't check the box in this market. We never even tried that when we started the Walmart Shadows, because it doesn't tell you what you need to know. We were able to early on get access to what I would call a version of Walmart sales. And it was as simple as basically if Walmart was doing enough sales, we didn't care if the town was 7,000 people or 20,000 people. We knew that there was enough people going there too, that it was bringing in that regional draw. And so again, like that, if you have all that, it's the same property in every single one of these markets we're going to. And it's almost the same underwriting and analysis for the tenants as well.
When you're looking at that, are you kind of solving for two things, reducing the risk you have of Walmart leaving, and then also ensuring that there's enough traffic and perhaps income or money flowing through that part of town to support your tenants?
Yeah, and so a key part of that too is making sure that there's not too much grocery competition, right? So the simplest way of thinking about it is Walmart is, like I said, like the center of these towns, and primarily it's grocery. That's where most people are doing all of their grocery shopping. And so what we liked about the asset class to begin with the shopping centers next door, was that they were all, one, complementary of the services needed by those consumers, complementary of Walmart, and also like it's going to be the highest trafficked area in that town. So we knew that we could always compete even with higher rents versus a C-class center down the street where you could pay way less rent, but you're not going to have the same traffic, the same consistent draw that you're always going to get being next to the Walmart. Basically, that was the most simple way of putting it. And there's some other factors too, right? So like it's totally different even if there's a town with two Walmarts, right? There's a lot of times there's a Walmart that's way up next to like huge power center developments and everything else, and there's a couple other big grocery stores. It's a totally different model. There might be 10 other strip centers. We want to be the number one strip center next to the most trafficked area, so next to that Walmart that is truly like where everybody's going, so that way it takes another layer of essentially risk out of the picture, because we're not competing with any or nearly as many other shopping centers for tenants and that sort of thing. And if somebody wants to come to town, they're always going to want to go to our center first. Doesn't mean that the economics are going to work out for them, or at the end of the day, it works out. But at the same time, we know that if they're coming and they're looking, they're going to first want to be in our center.
You touched on it briefly, saying your centers are next to Walmart, but what exactly is a shadow center? Are you sharing a parking lot with a Walmart? Are you literally next door? Can you be across the street? Can you kind of expand on that terminology?
Yeah, so I mean, it is as specific as either directly connected to it. A lot of times we're perpendicular. So, if the Walmart's like basically we're sideways next to it, we could be out front. And we also do have some that are directly across the street. Again, it mainly comes down to every market's a little different, and it comes down to, are we the best center in that town? And there may be two centers that are both equally as good, but at the end of the day, we're not half mile down the road. Like, we are at the center of that density of traffic, and we are truly feeding off of the traffic that Walmart's getting.
I would imagine, given the fact that you're across the country, 26 states, correct?
Or 27.
27 states. Your deal flow is probably coming from multiple sources. Well, let's say if through a broker relationship, a deal came across your desk and it checked all the boxes that we just talked about, how would you go about, or what would your DD process or underwriting process look like if you say, hey, the market makes sense, the Walmart makes sense, now let's look at the property?
One of the unique things about having a niche like we do is that we can add value to properties that are 100% leased, 80% leased, completely vacant, everywhere in the middle. But it comes down to the factors that make that possible, right? So traditionally, like on average, our price per square foot of a property is about $120, $130 a foot on average. So that includes, properties we buy with a lot of vacancy, 100% leased properties, kind of like that middle ground there. But a lot of it comes down to basically, is there value to create through leasing? Is there value to create through, replacing existing tenants with what is market rate tenants today? What's the timeline for that? Obviously, price at the end of the day dictates your ability to create value. So, we're not buying stuff that's 100% leased with high rents that, as a low cap rate, we're really the only value you can create is through some 10% rent bumps every 5 years. And your downside is you start losing tenants that you may not be able to replace with that rent, or it's going to cost a significant amount of TI. So we avoid that kind of stuff. But at this point, we have it down with doing this for so long. We have a pretty good gauge on what exactly the rents this market can support. What is the likelihood that we're going to be able to get tenants in our back pocket and they're quick enough? We're in a really unique time right now that allows us to be a lot more achievable in the sense of, like, if we're looking at a 90% leased property, all of the boxes are checked, price makes sense, this, that, and the other. Historically, there's a lot of tenants that have been there since these things were built, and most of these were built from 2000 to 2010, somewhere around there for the vast majority of them. And there's a lot of original tenants in there that, are a little bit oversized. They've hit caps on certain triple net reimbursements years and years and years ago, and they pay low rents, but they've had options throughout this whole time. We're in a unique time now where most of those tenants are going to be out of options when their leases come up over the next few years. And so when we used to have to speculate the assumption that they're going to renew, now we can, with more confidence, make the assumption that they're going to leave or pay the market rent, and also know who's going to be able to backfill them. So a lot of times, if there's a 4,000 square foot tenant that we'd like to replace, we know that we could split that space in half, and which tenant's going to go in there and pay 3 times as much rent on, the original rent the other tenant was paying. So going back to kind of like, how do we look at underwriting the actual property? it's all those things combined, but at the end of the day, it's just how can we add value to this property and what price do we need to buy it for that to be achievable. So we'll pay lower cap rates for properties that have a lot more vacancy, especially in markets where we know that we're going to be able to crush it to get those deals done, and also be really diligent on not overpaying for properties that have value to add, but maybe it's not as tangible in the beginning. You can't access it that quickly. But even that underwriting's gotten pretty quick and methodical. So now, for the last few years at least, every offer that we put in is as is, and most specifically for capital improvements, so like roof, parking lot, like we're not going back and retrading on those types of things. So we build that in up front. Our properties basically have 3 different types of roofs depending on where they are in the country, right? Same with parking lots, and we've done enough roof replacements and all that kind of stuff to kind of know how much it's going to cost. And so we get as much information as we can on those sort of things up front. But the big part is that we build it in up front to make sure that, we're not going to end up 60 days later having to ask for credit, because nobody likes that process. And it also is a waste of everybody's time, right? So just over time, from the really specific market criteria to the really specific ways that we need to be able to add value in the properties we're buying, how much it's going to cost to, get those tenants in there, to replace a roof if we need to, and, always using, not making any assumptions on cap rate compression or anything like that. If all of that works and you're not too conservative, but conservative, then it's pretty easy to know if a deal's going to make sense or not.
So I'm seeing a lot of similarities between what you guys do and what we do. We also don't retrade, and we try to factor in exactly what our CapEx may look like before going under contract. And the reason for that on our end, and I'm sure it's similar for you, is aside from making people angry, it's also building that reputation so the deals come to you. I'm sure the brokers are going to send you a deal over the guy that's or the guy or girl that's retrading, every single deal they get under contract. And then the other piece that I found interesting that's similar to us is you mentioned buying at a quote low cap rate because you know what kind of value you can add. We're the same way, where the going in yield or the as is yield isn't extremely important, because based on our history, our operational focus, we know exactly how that property, in our case, apartment community, is going to operate once we get our hands on it and do what we need to do. Do you have anything that you're looking at today to where it's like, okay, going in, regardless of what we can do, this has to look like, an X yield on our investment day one? Or is it more so, by year one, we want to hit X, Y, and Z?
It's more the former, and traditionally throughout time, and going from, again, we started even with Walmart Shadows as syndications, then we did a fund, and then we did the private REIT. But everything that we've bought has cash flowed to investors day one. The beauty of having more of a consolidated portfolio is that you can take on some more of those projects that are going to take time to really start cash flowing. So some with like a lot of vacancy and that sort of stuff, and throw in some of those that may be at lower cap rates on the front. But high level, outside of those extraordinary deals, it's the roots of it all still on a property by property basis, the fundamentals of lower risk. And even I'm talking about these properties that have tenants that are paying what I'm saying are below market rents and that sort of stuff. In a worst case scenario, if they stay or if they leave and we can only replace them with a similar rent, great, right? Like that's downside that is a lot more, digestible than saying we have to hit this return, and if all these things don't go right, then we're not going to be able to do it. So like that's a core of everything that we have, like in the very beginning till today on the property by property basis. It's that everything works day one and it's as little risk as possible. Now we're able to really, with a track record and just how things are going now, obviously be able to create more value than even I thought we'd be able to do. There's a lot of factors that go into that, but at the end of the day, that's kind of the first look is what's the downside, obviously, and how do we minimize that downside as much as possible.